if I were to just tell you, hey, look, it's a hard environment to borrow money. Most people aren't looking anymore. A lot of the people who were looking 2 years ago are trying to hold on to their money for dear life, and they're trying to, tell their investors everything's okay. We don't have that problem right now. If that's the situation, prices are down 20%, fewer buyers are looking, it's a harder environment to get things done. That's a good time to buy. I mean, if you can finance a deal in this environment, I wouldn't lock in for 10 years necessarily, depends on the property, but if you can finance a deal in this environment, if rates start to get cut, if demand starts coming back into the market, if this 80% on the sideline gets back in, I think there's going to be a lot of demand for your properties. And again, you get burned when the market's hot. What does Warren Buffett say? Like, buy when there's blood in the streets. Well,
100%.
We see people having problems.
Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all.
Real estate experiment. What is happening, y'all? Today I have a gentleman who comes into the lab, and we are overdue because we haven't had a multifamily subject matter expert investor who again walks the walk, talks the talk. That's what we do here in the lab. We have practitioners roll up the sleeves who are out there actively making deals, and the sleeves are rolled up. If you're listening, Will Matheson, the co-founder and managing partner of Matheson Capital. Man, Will, what's going on, man? Welcome to the lab.
Thank you for having me. I appreciate it.
Absolutely, man. I got to give you a little bit of context and roll out the red carpet because we were just talking offline a little bit. But you and your brother, Evan, co-founded this company. And from what I understand, you guys had a foundation of education of real estate. You guys had an opportunity to either go the corporate route or kind of start your own thing. And I don't know if that's how the trajectory happened right away. So I want to hear, now that I have you live, understand how you're able to have acquired all the dozen multifamily acquisitions that you've had, that over $100 million worth of real estate, and specifically with a niche in multifamily. And that's why I love having the show, because there's so many different ways to skin a cat. And you guys we're welcoming back the niche of multifamily in the space. It's been a little while because we've been on a very SDR-driven marathon while we've been in the lab. But we started off with a lot of multifamily syndicators. But what makes your story unique? I know that you're twins, so you have the cheat code. That's what I believe, because the way I've seen twins work in my life, my God, it's like one person picks up the other's doing the other. But I want to hear, is that the reality for you and Evan? How did this real estate empire begin? And taking a step back, tell me about Will and Evan, because I believe a business is always a representation of who the operators are behind. So tell me about Will and Evan, minus the real estate first.
I mean, my brother and I, we're obviously twins, as you mentioned. We're from South Carolina. Put it mildly, we've been best friends pretty much our entire lives. I think when we were in third grade, there were two other sets of twins in our class, and they did not get along. Not like one set versus the other. The twins did not get along with each other. I always thought that was the weirdest thing, because we've been best friends our entire lives. Only time we've ever really been apart, we went to different undergrad. We went to different colleges for undergrad, but even then, talked all the time, et cetera, et cetera. And then the company actually got its start because we were both working in North Carolina for Marcus and Millichap as brokers, primarily doing retail. We had a client who was in a 1031 exchange, and they split their exchange. Instead of putting all their money into one property, they put it into two. And because of that split, they ended up with $1 million equity shortfall for their second acquisition. Our boss comes to us and says, we need to find a hard money lender. We need to get them this $1 million. They don't want to deal with the tax consequences, et cetera, et cetera. And, Evan and I, we walk and talk. We were on the phone with each other, just walking around, and I can't even remember which, but one of us just had the idea of like, I think we could raise this money. I think we could raise $1 million, lend it to the guy. You know, we were pretty confident that they would pay it back. Because we were brokers, we knew what else they owned. We had a good insight into the net worth, everything like that. So we really started the company in 2015 when we were 23 years old as a hard money lender. That was our first deal. We did that for 16 months. And it wasn't until, we had left brokerage. We went to Columbia University for their master's in real estate development program. Started in May 2017. We're going to graduate May 2018. It was in January 2018 where we bought that's when we bought our first deal with another one of our classmates from the program, a guy called Mitch. Hey, Mitch. So and ever since then, we've just been buying and selling, buying and selling, buying and selling. And as of this recording, done 13 acquisitions, I want to say, 7 of which have already sold. So that's kind of the long end of it.
That's what's up. Listen, I gotta rewind you for a minute, man, because that's why I appreciate this, because I want to get behind the lens of like, okay, what's going on behind the mindset, right? A lot of this show is for the mindset, like what went behind that thought process. So let's build a little bit of context here. So between you and Evan, who's the I guess who's more aggressive when it comes to making a decision, or do you feel like you guys are actually pretty identical? Is there one that's more like, hey man, like we should think about this, and the other one's like, hey man, like fire aim?
I would definitely say that I'm more of the gas pedal and Evan's more of the brake. And that's to a certain extent because of the way we divide up responsibilities. I do a lot of the legal aspects of things, but it's also primarily my job to, talk to the brokers, find the properties, get the stories. And we say for consistency's sake, Evan underwrites every property, or he did before we started adding members to the team, because we wanted all of them underwritten consistently. Every property needed to be underwritten to a consistent standard. So, there's not a Will underwriting or an Evan underwriting. There was always that. But the real answer on why he does it is he's a phenomenal financial modeler. I think he's redone the financial models at every place we've ever worked. His test was used at the answer key in grad school. So, he's very good at it. So we just put it all on him. And accordingly, because of that, Evan would always be the one saying, no, I'm worried about this. I'm worried about this. I'm worried about this, because he's in the numbers and I'm talking to the broker. So I'm like, no, let's go. Next deal. Yeah. Let's do it.
Yeah, totally. And for those who are not familiar with what financial modeling entails in multifamily, do you want to give a little bit of a 30,000 foot view of that?
I mean, putting it at a high level, financial modeling is, this is the income, this is the expenses. These are them currently. This is where we think they can go. This is the cash flow we think we can generate, how we can grow the value of the property through the NOI. And this is where we think we can sell the property for in the future.
Got it. And so when you're at Marcus Millichap and you're working in retail, talk to us about what that means. And the reason I'm framing the question this way, I want to understand the paradigm that you had when you saw the opportunity. So what kind of level of foundation did you guys have at Marcus and Millichap?
Yeah, so at Marcus and Millichap, I mean, we really were retail brokers, selling your Dollar Generals, your Bank of Americas, your strip centers, stuff like that. As far as what we took away from that, I think it was a very helpful thing to do insofar as, one, you spend every day dealing with real estate, which I know a lot of people jump into the industry, they start buying properties, that maybe they're an accountant, maybe they're this, maybe they're that. They're jumping into real estate for the first time. It was beneficial to be able to learn about real estate. And we did some student housing and we did some multifamily. So we got exposure to other asset classes, but we were also being paid to work in real estate at the time. The second thing that was really great about Marcus and Millichap is it really teaches you to deal with rejection. There's a lot of cold calling involved. When you're trying to raise money from investors, there's a lot of, I don't want to do this. I don't want to do this. When you're trying to broker deals, get retail listings, a lot of people do not want to talk to you. A lot of people are like, no, this is my retirement. I 1031 into this. Leave me alone. You'd call 100 people in a day. No one wants to talk to you. Learning to deal with that rejection is pretty useful.
100%. I've been there, by the way, broker as well. And I used to, when I first got into real estate, I got tucked into, shout out to Deborah Harris, under her wing. I was just dialing, getting in. And I realized real quickly, you don't want to call the property management company. You know what I mean? Like, you don't want to get those guys. You want to go to the gatekeeper, or the source, the decision maker, I should say. But okay, that's interesting. So like, rewind. Like, how do you then see a deal come on the table and you think, let's become the hard money lender? Like, tell me, in what world is that the opportunity that you choose to tackle?
Well, I mean, the short answer is it was the only opportunity we really saw to do anything. You know, I didn't think we were going to raise a bunch of money from investors to buy a net leased retail asset. You know, if we raised enough money from investors, they'd just buy it themselves. But with the hard money property, I've had this question asked before. We really didn't think it was that risky, and I say that because we knew their entire real estate portfolio. We had insight into, you know, their net worth, all this stuff. I mean, they're buying, the exchange must have been $20 million or something. It wasn't small. And we knew they owned other assets, all cash. We knew we could get them to personally guarantee the loan. So it was very easy to say, we're going to put a first lien on this property you own all cash. With this $1 million, you'll get the $1 million. You'll personally guarantee the money. And we're confident you'll be able to refi this other asset or sell this other asset. It was purely a temporary thing. And, you know, with that story behind it, it was an easy sale in terms of raising money. Just, hey, look, you're in a first lien position. The guy guaranteeing this $1 million loan has got a net worth in 8 figures. You know, it's very limited downside.
No, it
Best
makes
case scenario, we'd foreclose on the property and take it. I thought it was worth $1.5 million.
Yeah, no, it's funny when you put in. That's why I love that you put it that way, Will, because you put things into perspective. And you're like, oh, okay, seeing it from a different lens when you hear that. And it's not so much like those who understand hard money, and you know, you might, if you're listening, you may have heard it definitely on the flipping side, hard money lenders. But let's talk about the numbers. If you still recall, Will, that made this a no-brainer. For our listeners, if you want to just kind of break it down of like what that looks like, the process of raising the capital for it, and then what kind of points / interest rate you were charging, and how much that money ended up actually working for itself, how long of a balloon. Like, if you want to just kind of go into that, I think that'd be very interesting to digest, if you still recall.
Oh, you're asking me to go way back. So I remember there were a few things that, I mean, putting it bluntly, at 23, we did not know everything. Mm-hmm. There were some certain things we did not know. So I remember one of the things I was very proud about us negotiating was we said, we want you to pay for all of our legal fees, because I don't want to agree to this $1 million loan and then you spend $20,000. You make us spend $20,000 on legal. Like, you have to do that. And I think it ended up being they had to pay $5,000 of legal. Maybe total legal was $6,000. We charged a point on the way in, just call it our acquisition fee, our sourcing fee, whatever you want to call. And then, oh, this is embarrassing to recount. I think we were on the phone with the borrower and they had asked us, you know, we had been talking about it, and our understanding, what we wanted was, I think, 800 over LIBOR, which was essentially 8%, because in 2015, LIBOR was practically zero, if I remember correctly. We're on the phone with them.
For those who are not familiar with that, what that means?
LIBOR, London Interbank Offering Rate, I believe, or overnight rate. I mean, it's sunsetting. It's not going to exist in a month. So by the time this is published, it probably won't exist. It'll be a Wikipedia entry. But it's just, you know, it's like SOFR, or just a really low interest rate. But what was it? When we were on the call with them talking about wrapping up all of the terms, I swear they said to us, so yeah, the rate was 10% over LIBOR, and we corrected them to, no, it was 8. It was 8. I think we could have gotten 10, but like, I was just so excited to get the deal done. Rookie
Oh my
mistake.
God. Wait, I
Yeah.
mean, what do you mean? I mean, this would have been written somewhere, right? I mean, are you saying this was like a verbal and then you were gonna send the paperwork or?
We had been discussing it, and
Oh my
they
God.
had misremembered what we had said. They had moved it from 8 to 10, and we could have we could have just said, "Yep, yeah, it's 10, it's 10." Didn't do that. Have never made that mistake again, in part because I've never been a hard money lender again. But,
Hmm.
yeah, we did that. I wanna say we ended up having that loan from maybe August or July 2015 to December 2016. It was about 16 months.
Hmm.
I think there was a point on the way out, and yeah, it was 800 over LIBOR over the life of it. Then raising money from investors. Some of it was cash. Some people were like, they were high net worth, so they just said, "Oh, I'm going to borrow a line of credit for this," and their line of credit was like 250. So even if they were borrowing
Mm,
the money, they didn't give us the money. They were still 550, or so they were essentially earning 5.5.
that's
So
crazy.
it was successful. It was nice. Another embarrassing part of that story is we forgot to tell our attorney it had been paid off. So we later brokered the property that the loan used to be on, and during that sale, the lawyer came back and said, "Hey, there's this recorded lien that hasn't been removed
Oh my
by
God.
you guys. What's going on?" It's like, "Oh, my bad. Didn't tell the attorney." Look, we learned a lot. I was 24 at the time.
Wait, that's crazy. Wait, so hold on. So you do that, then 16 months later,
16.
you, yep, 16 months later, 1/6, right? You you actually end up brokering, so you end up being on the wow. So this you talk about being vertically integrated on the transaction, right? So you end up brokering it and selling it to. Is that what you did, or you? Why did they sell 16
So
months later? Is that
So I think we were just repaid 16 months later, and it was a little after that. I don't remember exactly when. Maybe it was at the sale, maybe it was a few months later, but we ended up brokering the sale of the property we had the lien on, and realizing we had forgotten to unrecord the deed. So,
that's crazy? So then you do that once, it works, and it's interesting because in lab we call that an experiment that's gone well. The only thing we typically say we have a proof of concept, and I gotta ask you, did you guys when you did that? Because I'm big on like action taking, right? But I also like having proofs of concept. Did you have both, or did you just have one, or how did you execute this experiment?
well, I mean, to put it mildly, we had zero proof of concept. I mean, we were 23. Marcus and Millichap was my first real job.
Mhm.
So, I mean, outside of it, before we did it, there was no proof of concept. We just knew it existed as an industry, hard money lending. Afterwards, we have never done a hard money loan again.
Why was that?
Not just because we wanted to get into ownership.
Okay, so
Yeah, we started
yeah.
buying it.
Yes, because you're brokering, and that's one thing, right? As a broker, you're brokering on this, you're seeing the numbers, then you somehow come across doing a hard money deal, and then you're like, at what point is it like, okay, it's time to invest? Was that the play the entire time to make this money work for itself, and then, or was it more like a discovery of like, okay, well now that we got our money back, not gonna do that again, but let's get into these investments. What was the trigger that, or the seed that was planted for you guys to get to your first?
It wasn't a direct linear path.
Hmm.
When that was paid off, we were pretty happy about it. Obviously, we didn't plan on being in there forever, but by that point, we had already decided we wanted to leave brokerage. And when I say we, I do mean my brother and I. We wanted to leave brokerage, and we had applied to and been accepted to Columbia University's Master's in Real Estate Development program. So we enrolled there in, I don't know, May 2017. As I mentioned, we buy our first property, which is a duplex in Los Angeles, in January 2018, while we're still in school. And the nexus for doing that deal was, on the one hand, we had kind of been saying, well, this program's only a year, gonna have to get a job. We left brokerage because we wanted to be on the ownership side. And we were kind of asking ourselves, when we would talk, hey, what do you want to do? Do you want to do you want to go climb the corporate ladder for 10, 15, 20 years to, make all these connections and leave and start our own firm and, buy $25 million properties? Or should we just go out on our own? We've already raised a small amount of money before. We can start raising small amounts of money again, buy, sell, very quick hold periods, something like that, and assume that we'll build up a company and a track record that'll allow us to buy big buildings without climbing the corporate ladder for 10 to 20 years. And then our classmate brings us this opportunity. It's a small deal, 2 units. It was like $800,000 on the acquisition, but he thinks, he's from Los Angeles, he thinks there's a lot of opportunity. So we buy it with him, and we sell it 2 months later for like $985,000. I know, hard time. So that was really helpful. I mean, before we'd graduated, we'd sold the property, made some return, and then we bought another deal in May. And it was this accumulation of things that made us say, okay, really, we've now done it a few times. Let's go out and do this full time. I don't care if we're starting by buying a $900,000 property, an $800,000, $1.5 million property. Let's go start buying, value add, sell, buy, sell really quickly, and build out a track record, build out an investor base so that we can raise money and, hopefully instead of spending 10 to 20 years to start a firm to buy big properties, we'll cut the cycle short by 10 years and start buying bigger properties at a younger age.
Yeah, I love that. And what's funny? There's so many areas I want to go here. So you guys did the hard money deal before you went to Colombia?
Correct.
That's so interesting. So let me ask you, because one assumption I was making is one that a lot of people make, which is why I like the switching the whole lens or flipping it on its head, is, go to school, make the connections, etc. And which is, again, very it's not that it's not true, it's a route that people take, like you said, right? They go to a great school like you went to, Columbia, they have a network, they have connections. The elephant in the room is you guys did this before you went to Columbia, raising the $1 million. So where did that come from? Was that network? Was that family? Was that friends? Like who did you source to be able to raise capital? Which again, I think when you're in your position now, it might seem like nothing, but I think when you're thinking of a 23-year-old asking for that kind of money, I think there might be some listeners on the other side thinking, okay, like how do I replicate that?
All right, so the answer is the same answer that I say for anyone starting money, which is start with your friends and family. They're the ones who want you to succeed, and you probably have the most, I don't know what the right word, you probably have the most influence with them. They probably are the most likely to believe you. It's not exactly easy to walk up to a stranger who's never met you and say, hey, I have this idea, give me millions of dollars, I hope to give it back to you. That's my plan. When you start with friends, family, highest likelihood of success, smallest amounts of money to raise unless you're super lucky. But again, $1 million in the scale of real estate is not a massive sum. So we started by approaching friends and family. I will say, I think it helped that we were brokers at the time, because working in real estate full time did lend a certain degree of credibility in terms of, hey, we understand how this works. We've been brokering for however long it was at that point. So that was definitely helpful. But one of the things that I always tell people is when you're starting out, you want to do small equity raises, because you're not Blackstone. You're not going to go get a pension fund giving you millions of dollars to invest. Like, you're going to have to start small. You're going to have to raise money from the network you have in all likelihood.
Yeah.
So, that's where you start, and you branch out from there. That's part of the reason why, as I mentioned, we were buying $800,000 properties, $915,000. I mean, the price points of our acquisitions, I could rattle off: $800,000, $1.4 million, $915,000, $1.13 million, $3.3 million, $2.2 million, $2.75 million. Like,
Yeah.
I have all these ingrained in my head because, when you're starting out, raising $400,000 of equity, not debt, is very difficult, especially if you've done 4 acquisitions and you haven't sold all of the previous ones. And then, you're raising $1 million, and we had to find partners to help us raise that money because we had already done 4 acquisitions and we were running out of people to go to. And, over time we built that up. But that's a long way of answering your question to say, I think it helped that we worked in real estate.
Yep.
But you go to the network that's closest to you when you're starting, because everybody else is going to want, it's not that no one wants proof of concept, but the people you're closest to, you have the most credibility with, they're going to want to see you succeed. And when you prove you know what you're doing, it's a lot easier to go to, those third parties, those 2 degrees of separation to raise money.
Yeah, that's interesting. Because that's really it. When you think about this is one thing that when we speak to some either budding investors or beginner investors, my question to you is, was that duplex strategically acquired to have somewhat of a proof of concept, or do you feel that you already had more of that? Again, you studied it at school, you worked as a broker. Like, how much of your network identified you as Will Matheson and Evan, the real estate guys, or did you have to rebrand yourself in front of those family and friends to say, hey, no, this is what we're doing now for real, and this is who we are? Like, do you know what I'm saying here?
Yeah, I believe I do. The answer as to why do the duplex, is it to build the track record?
Mm-hmm.
Is it for the proof of concept, or is it, being honest, it was really opportunistic. We thought we saw a property where we could make a quick return, and we were correct. And that has the added benefit of building that proof of concept.
Yeah.
And then we go on to the next deal after we had owned that property for 2 months. We have, including the hard money loan, now we have 2 deals under our belt. That's building the proof of concept as well. And by the time we were buying properties in 2019, it was still difficult, don't get me wrong, but 2019 it was so small. I swear we added something like 3 new investors directly in 2019. I used to have these numbers memorized. In 2019, we added 3 investors that we brought to the table, new investors. Our partners brought in like a dozen. And then in 2020, we added something like 6 or 10 new investors. And then 2021 rolls around and we're adding 17 new, and it does have a compounding effect.
Yeah. I was just going to say that. Do you find that a lot of the partners are inviting people that they know and doing third-party introductions, or is it more of like, who else do you know that would be interested? Like, is it a combination, or which one is it?
It's a combination of those, but that's also one of the reasons why so many of our early acquisitions were short-term holds. As great as it is to go out there and tell someone, hey, I've made all my quarterly dividend payments for the last 3 years, isn't that phenomenal? It doesn't jump off the page quite as much as, hey, look at this 40 IRR I delivered to my investor in 1 year. I took their 100, made it 140 in a year. Wouldn't you like to do that too?
Mm-hmm.
And then you do that for your investor. That means they now have 140,000 they can invest in your next project, and now they're telling their friends, and you're building up from there. Again, that's it. I always say there are 3 bottlenecks in this industry. Mm-hmm. You can either have access, your access to deals. How many deals can you actually see? There's your ability to underwrite those deals. We've had periods where I could get more brokers to send us a deal than we had time to underwrite. We had to say, stop sending them. We're done. Yeah. And then there's your ability to raise equity. And when we started out, our bottleneck was our ability to raise equity. So that's why we bought smaller properties. That's why we sold them really quickly. Theoretically, I'm sure that, if we raised $500,000 on one deal, the deal we bought 2 years later was probably using that same $500,000, just being raised a second time. Yeah. It's hard when you start. Another conversation I've had with people, we were talking, they said, oh, it was someone who wanted to get into the industry. Maybe you've heard this. I'm sure this has been said on your show. I don't know how many times people say, oh, if you have a good deal, the money raises
The
itself.
money will find you, right? Yeah.
I said, absolutely not. That is dead wrong. Like, and I asked the guy, who told you this? He's like, oh, this guy. How old is he? The guy I was talking to is 30. He said the guy who said if you have a good deal of money, you'll follow. He's like, oh, he's like in his 50s. What did he do before he did real estate? He was a Silicon Valley CEO. Like, well, yeah, when that guy says the deal is great, of course he finds the money. He probably knows every rich person in California. Not everyone. Yeah. It's like, of course it works for him, but like, you're 30. Like, you don't have that credibility.
Yeah.
And I'm not doing that to knock 30-year-olds. I'm 31.
Mm-hmm. No, 100%. 100%, man. No, dude. So it's such a good point. I'm so glad we're talking about it because I don't like these loose kind of sayings without having real context behind it. So you mentioned you're 31. You're obviously very, very young in this space, or at least you're just scratching the surface. Tell me about the type of assets that you were buying before. Right? You mentioned 1.4, 800, 900. What were those? Where were you buying them? And then I want to talk about what we were talking about offline as well. It's like, where are we headed, right? So what were you buying before in your relative short window of time that you've gotten started, and where are we going now?
So in 2018, I bought 2 properties with a classmate. Evan and I bought 2 properties with a classmate of ours from Columbia, Mitch. Those were both in Los Angeles. By 2019, we had determined we didn't want to do that anymore. We wanted to invest in the Carolinas. We wanted to, really focus on growing our investors and our projects. Our investments in the Carolinas in 2019, 2020, 2021, they were largely, low unit count because, again, we're not raising a ton of money. If you're not raising a ton of money, then you're not buying 100 units. Mm-hmm. So they were smaller properties, sub 100 units, and they were all designed to be very quick value add properties. Sell it. We would tell investors, here's a 3-year pro forma, but our plan is to sell it in a year and a day, because we wanted to build that track record and we wanted to be able to buy larger and larger assets and also give our investors, a nice pop on the return. One thing we would tell people is, when you're investing with us, we're not asking you to marry us for the next 10 years. We're not buying this property, putting 10-year agency debt on it and saying, hey, I'm 28 years old, invest with me until I'm 38. 10 years ago, I was a senior in college. It wasn't the best sale. Like, we didn't want to make that sales pitch because we knew it wasn't a good one. We said, you're dating us for a year. We'll get in, we'll get out. If you like it, tell your friends, come back, do it another time. Yeah. So that's, what we were buying. And we did have the opportunity, I will say, to work with a larger sponsor, a billion? Yeah, we did have the chance to work with a multi-billion-dollar sponsor on a couple of larger student housing assets in North Carolina, where we got to raise money for those and advise, and we got some larger acquisitions through that. That opened the gates to a lot of credibility. It gave us a lot more visibility. It probably tripled the amount of investors we had on our mailing list just by working with that group. Because, people would see, oh, they're buying a $25 million property. Oh, they're buying a $60 million property. Like, that was another big step. I do think there's a time for strategic partnering.
100%. And talk about, because your first investment was $800K duplex. You got 2 units in LA, and then you said the Carolinas. How far, again, for context, those who are listening, can that $800K go in the Carolinas?
So our first Carolinas acquisition was 6 units, 18 beds of student housing in Boone, North Carolina. We then bought 15 units for $1.13 million. So I want to say $76,000 a unit, roughly speaking. Next property, 24 units for 3.3 million. So you're looking at north of 125. I think it was 137 a unit is what that math is. And then we're buying some other assets in the 70 a unit range, 80 a unit range, all of which have now sold. So the money does go a lot farther if you want to, it's easier to buy more units in the Carolinas than it is in California, to say the least.
Yeah. And as you're saying that, I'm just thinking about kind of the stage that you're in, coming out of school, you're starting to scale. Just for our listeners, because I know listening to, some of the operators on the short-term rental side is obviously a very different kind of cash flow and income. When you're operating that kind of deal, right, and you're an operator and you're maybe the managing partner or however you've positioned yourself in a deal, how much of that is more of, okay, we're letting this asset grow, or can I actually live off of this model? Like, just so to paint a picture, right? Are you able to live off of the points? Are you charging anything? Or are you putting some of the money down? Are you just raising capital and not having any skin in the game? Are you rolling your commission in? Like, what does that look like, especially in the beginning as you're looking to kind of gain that traction?
So the answer to that is, in the first few years I was doing this, I was making a lot less money than I did as a broker. It is really difficult to, if you're buying, let's say you're buying $1 million property, even if you're charging a 2% acquisition fee, 2% asset management, and then you're getting a promote on the equity. Well, to put it mildly, I mean, doing 2% on a $10 million property is $20,000. You're not making it through the year on that much money. The asset management fees, 2% of EGI, doesn't really amount to much either. I mean, if it was a 6 cap with a $60,000 NOI, you're looking at it's not 12,000, it's $1,200 of asset management.
And you meant, I think you said a million, 2%, that would be 20K. I think you didn't say 10 million, did you?
Oh no, 2 million. Like if your first acquisition is in the $1 million range, which ours, we were doing acquisitions of that size, your acquisition fee is 20,000. So another part of the strategy, and again, we told all of our investors this, was, we do buy, sell very quickly because we want to collect the acquisition fees and we want to collect the promotes on the back end. We had incentive structures in our companies where, if the investor gets this % return, anything over that, we take a bonus. So if we sold these things, the faster we sold them, the faster we would earn our bonus, the faster we could move on to the next acquisition, et cetera, et cetera. It is difficult. It is very difficult when you're starting out buying small properties. Like I would expect to lose money in the first year or so.
Yeah. And I've heard before that on the, you want to keep the structure lean and not complicated because people don't understand how they won't do business with you if they can't understand you. So how like straightforward do you make it with, again, this might be a friend or family. What is it? I know you just said it, but is it as simple as that? Like, what is it that you would say to an investor to say, hey, listen, we're going to go in, I have my acquisition fee, 1% up front, 1% on the back end. Like, I just want to hear that for our audience so we understand kind of like that terminology, because I think it's good for them to dive into that if they're looking to get into the space.
So our structure was typically a 2% acquisition fee, a 2% asset management fee, and that's 2% of total income. So, if a property makes $100,000 in a year, we could charge $2,000. It's not net operating income, it's gross income. And if on the back end, we typically wouldn't have a disposition fee. What we would have is, we'd give investors an 8% preferred return, and we would take 30 cents on the dollar over that 8%. So the pitch to investors is it's 2% acquisition fee, 2% asset management, which really didn't amount to anything on these small deals. A lot of the times we wouldn't even collect it. It's just because it doesn't move the needle for anybody. And we would tell them, look, if you get an 8% return, you're not going to be, You're not going to be mad. That's a good return in the stock market, but you're not going to be happy. You'll be like, okay, it's fine. So if we exceed 8%, that's when we start, that's our incentive to get as high above that as possible. So that was our basic structure. It wasn't 30 over 8 and 50 over 15 and da 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 da. It was reasonably straightforward.
Yeah. Are those like when you start getting to like the waterfalls and stuff like that? Is that what
Yeah, it was just a one layer waterfall of just 30 over 8. It's fairly common for syndication.
Yeah. By the way, does that number change? Because, being, a licensed realtor / broker, you're like, you get 3% is what you're used to. And then you get into these like $25 million homes and it's like, oh yeah, by the way, it's no longer 3% because it's a big deal, right? So does that change the acquisition / asset management fee as deals get bigger, or are things structured differently? Or is this more or less a very similar foundation used across the board?
It's more about who your equity is than it is about the size of the property. If you were to do a $10 million acquisition with a joint venture, a joint venture equity partner, some private equity firm, some institutional group comes in and they give you all the equity, they're going to come in there and say your acquisition fee is only 1%. Your promote is not going to be a 30 over an 8. It's going to be a 20 over a 10 or something like that. Whereas, if you can syndicate a $60 million property and your investors are okay with you charging 2% on the acquisition fee and 2% on asset management and 30 over 8 on the promote, you can do that. It's really not dependent. It's more so dependent on who is bringing the equity as opposed to the size of the property. Those two kind of come together, though, because there are not a lot of people who syndicate a $100 million property. That's a heavy lift. So you don't typically see syndication at that level.
At that point, what are you saying? It's sponsors, or
it's just mostly institutional investors. If you're buying a $100 million property, that could be a $30 million, $40 million check. Not a lot of people want to syndicate that money, but your pension funds, your private equity groups, that's, again, to use the name, if you're Blackstone, $40 million is a rounding error. Maybe not quite a rounding error, but they're very impressive.
Experiment Nation, you've heard the word MTR, midterm rentals, as it is currently a hot topic and hot commodity right now because, again, there has been an increase in short-term rental regulations, and there also has been, let's face it, a slowdown in what we were experiencing a couple years back when it comes to bookings. So with that said, short-term rental operators are looking for alternative solutions to tap into the midterm rental space. However, there is a sub niche of midterm rental insurance that I'm truly excited about, that I want to share with you, that the experience that we've had, the tremendous results we've been able to have, and that's the insurance midterm rental space, which is very different than your traditional midterm rentals. When you think of traditionally midterm rentals, you think of travel nurses. There is a space, midterm rental insurance space, that we've tapped in, where you need to be well connected with insurance and relocation specialists and companies and understand the right type of asset required for you to be able to help these families. What's really important that stands out the most, which you can get in what I'm about to offer you, is the understanding where to be found by these insurance companies, how to properly manage your calendar so that your listings are optimized so that they can find you, how to actually gain traction and build a relationship with these relocation insurance companies. I've put together an MTR insurance blueprint. That's MMTRRR insurance blueprint to cover these foundations after we've had success landing very large contracts on single family homes that literally 4x what we traditionally make in long-term rentals, and also gives us peace of mind because there's less turnover and 100% occupancy, because these contracts can start anywhere from 30 days to 3 months to 8 months and range anywhere from, again, we've landed anywhere from $8,000 to $9,000 a month per month on a single family home property, which Our mortgages are typically around the 2,400 range, which then gives you a large spread of anywhere from 4 to 6K net on just one property. And this is why it's very hot right now. But people who haven't been in the lab with individuals like myself, like Jesse Vasquez and Dr. Rachel Gainsborough and Noble Crawford, don't have the foundations and don't know exactly where to start. And therefore, this is why I'm giving you guys a blueprint, the MTRR Insurance Blueprint. Go to the website, experimentrealestate.com, and get yourself a blueprint to completely change or at least have a plan B if you're a short-term rental operator looking to maximize your occupancy and profitability. We'll see you on the other side.
That's interesting, man. No, I appreciate you sharing that. And let's talk about what you kind of like the next phase based on what I heard. You mentioned sponsor. Can you talk about what that's like? As, you know, you hear, we've had the Jake Genos on the lab. We have Joe Fairless, all those guys. Help us understand. There's a lot of investors coming in as limited partners, some MPs. What is a sponsor and how can that help? I think I heard you mention being very strategic in your partnership and it kind of giving you that exposure. What is that for our listeners so we understand what that next level might look like as you take that next step?
I mean, a sponsor on a deal is just whoever, you call it the managing partner. It's the person who signs on the debt, who raises the money, who puts the deal together, who is ultimately responsible for the day-to-day operations on the of overseeing the investment. That's, in short, that's who the sponsor is. It's not dependent on the size of the acquisition. LPs, limited partners, they, realistically, you buy the property, they have no obligations. They don't have to do anything, which is the point. That's the value we add. We try to get you above market returns for you not having to do any work.
Yeah.
The only reason we get the bonuses is because of the work we do.
100%. What does it look like when you said you were going in on these bigger deals? Talk about that structure of like the $25 million deals. How did you get your foot in that door, and what does that look like for if I'm Will 5 years ago or 2 years ago or 3 years ago, whatever that was, getting into that door? What does that look like?
So, as I mentioned, the three bottlenecks earlier, finding deals, analyzing deals, raising money. Ours was always raising money. So we never wanted to partner with somebody else where we were raising money for their deals, because inevitably when you're not the lead sponsor, your economic returns just keep getting worse and worse and worse and worse. So how we ended up in that property, we were competing for the acquisition. We found out who was going to win it, and we realized that, we know those guys through a friend of a friend, that type of situation. It was their first acquisition in the Carolinas. It was a market that we knew very well going back to our brokerage days. So we tried to set up a call. We said, hey, look, we think these are some things you might not know about the market. You can increase your efficiency by doing X, Y, and Z. We'd love to be involved in this project with you because, you're obviously the lead buyer. We get that. We think we can add value. So we came to an agreement. We'd raise money for the property. We'd obviously add additional advice, market expertise, things like that. But, so we got to come in, invest in the project, and get a little bit of a bonus on top of that.
Dude, that's a very, and I love these strategic approaches of how you describe that. So, you and Evan were actually looking to acquire this, and then you saw that the big fish was probably going to get it. So you're like, okay, why don't I stand on the shoulders of giants? But then I'm going to add a little bit of value, or a lot of bit of it, by literally delivering the value as you're reaching out. Tell me about the financial commitment, and then during the lifetime of that deal, I don't know how long it was, how you're involved. Are you coming in as an MP at that point? Like, how does that work when you're coming into a deal of that nature?
I mean, that really depends on every individual partnership. I mean,
Yeah, for sure.
we've worked with partners before where they're a minority partner among the managing partners, but they still oversee a lot of the day-to-day operations. The group we're working with, they're very sophisticated. They've done something to the tune of like $5 billion of operations. We gave them our input. They listen to it. They implement some. We raise money. We don't really have any obligations at this point. They have things pretty much under control. We still talk to our investors about it, but look, they were roughly, at the time we did that, they were 100 times our size. So I think you could understand that I think they've got it in pretty good hands at this point.
Yeah. Did you need to have skin in the game to get on board?
We invested, and we also raised money as well.
So that was kind of the, for lack of better words, agreement of, you can come on board with us. Here's the requirement. Is there I'm just curious, never been part of those deals, right? Those kind of much sophisticated deals. Is that like in a contract where in order for you to invest with us or be part of this or sit at the table, these are the things that you need to do? Is there a quota? Is there a cap that you need to raise? How does that look like?
I mean, again, that depends on every specific project.
Yeah, and I'm not asking.
For this one. I mean, one of the things for that is it's kind of difficult to say. Let's just use a hypothetical example.
Mm-hmm.
If I were involved in a project where lead sponsor takes down the deal and they need to raise $10 million, and I was like, hey, look, I'd love to work with you. Let me raise $3 million, but I only raised $2 million. It's not like they're going to say, no, I'm not taking any of your money.
Mm-hmm.
But maybe, I mean, obviously I didn't add as much value as I wanted to. Maybe I have 4, but they say, no, I'm only taking 3. It really depends, but everything is different. You just maintain communication throughout. I tell people again, when it comes to your bottlenecks, I know people out there who they're very good at raising money, but they're very bad at finding deals, which is a mystery to me how that's possible. I'm always impressed by that problem. But that'll be their shortcoming, and they love raising money. That's what they do. They structure it X, Y, and Z ways. But, for us, it was, like I said, raising money was always difficult. It was hard to raise money for someone else's property, but given the size of it and where it was in the markets we targeted, we said, we think this is a good strategic decision. And, that was the end of 2021. 2022 was our best year ever. And 2023, even 2022, even in a slowing cycle, was our best year ever.
Incredible. So this is a good segue, and I love how you put that FAR, the finding deals, analyzing deals, and raising capital, the 3 bottlenecks, far from being rich if you don't get those things done. But let me ask you, you were talking about this, and let's put a bow on this and bring it full circle. One of the things you were talking about before we got online is the temperature of this market. And one of the things I previously asked you was, hey, Will, you started buying duplexes, then you kind of scaled up, you got the 16 units, you started going up, right? And then now in this market, you hear, well, people are overpaying, et cetera, interest rates, et cetera, whatever that you've heard it, right? So as far as now, is it seller notes? Is it seller financing? Is it creative financing? Like, what is making things work for you and your team? And how do you see things kind of looking? Again, not asking you to look into a crystal ball or anything like that, but just curious with all the data that you're constantly looking at and collecting. Where are we now? What are you buying? And then where are you going? And what opportunities do you see?
Well, I'm glad you used the word in the beginning of this question. You used the word temperature. What's the temperature like? It's obviously colder than it was in 2021, but as you and I were discussing off air, it's when the market's really hot that you get burned. I say, obviously, there's some problems with some multifamily properties, but even the properties that are having problems, it's not necessarily I mean, okay, in a lot of cases, it has nothing to do with the operations of the property. It's not like we have a surplus of housing supply all of a sudden. These properties that are being foreclosed on, a lot of the times, it really just has to do with the debt that was on the property. They took out they bought at a 3 cap with floating rate bridge debt in 2021, and then rates went up 500 basis points since March of last year, and their debt is now 9%. And yeah, 9% debt on an 80% levered 3 cap is not a very good combination.
And
So
and can
as
you
for the temp- Go
and can
ahead.
you, Will, just for the audience, just help us understand like the the product as to why it's able to go up? Because you hear some people are listening to this and they're like, hold on, like my mortgage is 30 years, I'm locked in, right? So how is this thing going up? What kind of product is it that they're using that it's making them go all the way up to 9%, and they've basically getting wiped off from underneath them? Like what is this thing called?
Yeah, so I mean, to overly simplify, there's two types of loans out there. There's fixed rate loans, which most mortgages are. In commercial real estate, you'll get a 5-year fixed rate loan, a 10-year fixed rate loan, a 7-year fixed rate loan. You know what you're going to be paying for the next, however many years. Then you have floating rate loans, which typically, it's 250 or 300 or 400. Pick your number. Over SOFR or LIBOR, which we had discussed earlier. And, in 2021, when rates were still zero and you could take a loan at 350 over SOFR, you'd pay 3.5%, where if you wanted to get long-term fixed rate, it might be 4%. And a lot of people opted to take the floating rate because they wanted to save 50 basis points on their loan. And that has not worked out to their benefit right now. They're, because when SOFR increased, when the Fed increased rates, everything became a lot more expensive. And that's how you go from that 4% loan to that 9% loan today. So again,
do you call that, do you see that, like, it almost sounds to me like don't be a penny wise and a dollar foolish, but do you see that, is that foolish? Do you blame someone for that? Or are they thinking that when that happens, I'll be able to, like what do you see now, and what can we learn from this when the rates are low? Why would someone take advantage of that, and should they even take advantage of that floating rate?
So, I mean, was it the smart thing to do? Were people being unrealistic when they made the assumption? The answer is no, they were not being unrealistic when they made that assumption. The other side of that coin, though, is you could say, well, rates were at zero. So if you locked in for 10 years when the rate is zero, it will literally never get lower than this. So on the one hand, it would not have been dumb to lock in for 10 years. You probably, you might have lost some flexibility, but you probably, again, when the federal funds rate, when SOFR are all as close to zero as possible, and you put that agency debt on it, you're probably not going to regret that unless you want to sell, but someone could assume that loan. The reason I say I don't think people were necessarily being irrational or reckless or anything like that when they took out those loans is if you go back to 2021, I know it seems like it was forever ago, every forward curve for the federal funds rate was like, no, we're not raising rates. No, we're not doing it. No rate hikes in 2022. Maybe there will be a rate hike in 2023. I think it was maybe sometime between October 2021 to January 2022 or December 2021. There was some 3-month period where the Fed went from saying, no, there's a 0% chance of a rate hike in 2023. And then 2 to 3 months later, it says, yes, 100% there will be a rate hike in 2023. Inflation is no longer transitory. It's a problem. Now we have to do it after doing nothing. And then they went and increased rates for 10 or 11 straight meetings. And that's why people are in the problems they have with floating rate loans. So, yeah, that was a long answer.
No,
As
and I appreciate us getting into it because I do want to touch on that. I think you're hearing enough, and again, I don't have any floating rates or anything like that, so I'd like to understand because it's easy to be and look at these dumb investors. Like it's easy sitting on the sideline, right? It always is, right? So now it's like, okay, what do I learn from this? And so there's signs and there's trends, and it will happen again. So my goal is to educate myself and my community of not teaching them what to think, but teaching them how to think. And so when I hear that, was there, if you were to take the floating rate and you knew that maybe it could increase in the next 3 years, what is my exit strategy? Is it because they're thinking of I got to do it'll allow me to do work, save money, and then I plan to sell at that point anyway? Like, was that like, again, I'm not asking you to speak on behalf of everybody, but I'm just trying to understand like what the thought process could have been for some of these investors when you're making that decision to take a floating rate.
Well, I mean, the most straightforward answer is, in a lot of cases, it was the only way to buy a property. I mean, the competition that was going on from 2020, 2021 to the beginning of 2022 was absolutely incredible. You would have, I mean, it happened in the residential real estate market too. I mean, if you remember, you'd see properties hit the market, they'd get, $50,000 over asking price, and the person had never even seen it. Multifamily had a lot of similar things. People just bidding and bidding and bidding. And because floating rate debt is because the rate is typically lower than your fixed rate equivalent, the only way to buy a property was to use the floating rate debt. And again, I caution, everybody thought rates were going to stay low. And that was what the Fed was saying. That was what the market was saying. It wasn't some ice. Well, I was gonna say, it wasn't the Titanic sailing straight towards an iceberg that they could see. Poor timing. But that was the analogy that jumped to mind. Metaphor, maybe.
Yeah.
Everybody thought the rates were going to stay low. And if you were in a competitive environment, the difference between getting a 4% fixed rate loan and a 3.5% floating rate loan, the floating rate loan might get you a little more proceeds. It increases your cash flow to sell to investors. That was what a lot of people felt like they had to do if they were going to buy a property. And again, nobody anticipated rates changing the way they have subsequently changed. So, I mean, quite frankly, it's, to some extent, it's easy to sit here now, like you said, and say, oh, what a mistake. No, that was all of the conventional wisdom. In the same way that conventional wisdom right now has become the Fed is not going to cut rates by the end of this year. Maybe we'll start seeing rate cuts in 2024. If 6 months from now, a recession started tomorrow, the day after we recorded, and the Fed said, slash the rates. We're obviously, people could listen to this and say, hey, these guys had no idea. Everyone thinks this right now, just like everyone thought that back then.
Well, no, hindsight is 2020 for sure. So tell me, I guess you, in your situation, did you have any floating rates? Did you get bit? How are you doing, my friend? I mean, your hair looks wonderful, so I don't get that sense, man. You look good, man. What's going on?
My wife loves my hair, but it's a little disheveled right now. I was in a car all day, not a convertible, so I don't really have an excuse. So none of the deals where we're the lead sponsor have floating rate debt. We've always been a fixed rate company because we are more risk averse. We've also always been low loan to value comparatively. We've never used mezz debt. We've never used preferred equity. We've always been fairly conservative. Here's our debt. Here's our equity. We have a fixed rate on the debt. We sold most of our portfolio from Q4 21 to Q1 of 22. So our timing was pretty great, which allowed us to sell a bunch of properties, make investors very happy, and then buy up some properties in 2022 as the market was starting to shift. And, we're currently in the process of trying to pick up some loan assumption properties and other things. We are really, as of this week, I've been seeing signs of distress from people who do have that floating rate debt. It pops up here, it pops up there. I've had 2 conversations this week about, distressed assets, not property level distress, but financing distress. So,
what's their exit, by the way? When someone is at a 9% at that point, I mean, are you just selling ASAP? Like, it might be an obvious question to you, but I'm just curious. Like, what should an operator do? Is there an alternative strategy that we might not know of?
Well, so one option is to sell and try to get as much as you can. Even in this environment, if a property is listed for sale, it's not uncommon to get 20 offers. So you can try to save yourself that way. A new phrase I just learned last week is extend and pretend, which is just try to extend your loan, extend your hold, and pretend things are going to change. And I say pretend because as it's projected now, we're not going to see any rate cuts by the end of this year. So you're just hoping the situation changes, or you're pretending the situation's going to change.
And at that point, you're bleeding, right? Like, we're talking like, I mean, you might be negative.
I mean, there are groups out there that are offering what's called rescue capital. They'll bring in mezz debt or pref equity and join the capital stack. But I mean, admittedly, that seems like the definition of a predatory partner. Hey, your property's in trouble because of the capital stack, not the operations. Why don't I come in here and charge you 12%? But again, people are grabbing on for lifeline, or people are just grasping at whatever they can get their hands on right now. Some people are going to take the loss. Some people are going to take losses just because, they got unlucky with the financing. We saw that in Houston with the New York Times story about, was it Apple's Way or something? I believe their issue was floating rate debt, and they got foreclosed on.
It's no joke. Well, man,
like I said, we don't have any on the stuff we control. We don't have anything coming due. We don't have loans coming due for the next almost 2 years, maybe 22 months. So we feel like we're in a pretty good situation.
Yeah, I think your timing was right. That was good timing for sure. But again, not by chance. Everything is calculated. So I respect that on the other side here. Are you sitting by the sidelines and taking a foot off the gas on the gas, right? Or are you pressing on the brakes with Evan, or are you still actively hunting? And if so, what are you looking, and what do you like? What kind of product do you like right now in the marketplace? What area are you exploring? If you don't mind sharing with us here at Experiment Nation.
So we are actively looking. We're actually hiring and bringing on new people, and I say that because, as I said earlier, you use the temperature. When the market's hot, that's when you get burned. Right now, depending on who you listen to, 80% of buyers are not even looking anymore. Prices are 20% lower than they used to be. So if you're still calling the brokers, you can find that loan assumption opportunity. You can find that distressed sale that hasn't hit the market. Again, we'll look at, we've bought everything ranging from 60s product all the way through 2021 construction. We're looking in the Southeast, Carolinas, Georgia, Virginia, Tennessee. But, we think if you were to tell me, if I were to just tell you, hey, look, it's a hard environment to borrow money. Most people aren't looking anymore. A lot of the people who were looking 2 years ago are trying to hold on to their money for dear life, and they're trying to, tell their investors everything's okay. We don't have that problem right now. If that's the situation, prices are down 20%, fewer buyers are looking, it's a harder environment to get things done. That's a good time to buy. I mean, if you can finance a deal in this environment, I wouldn't lock in for 10 years necessarily, depends on the property, but if you can finance a deal in this environment, if rates start to get cut, if demand starts coming back into the market, if this 80% on the sideline gets back in, I think there's going to be a lot of demand for your properties. And again, you get burned when the market's hot. What does Warren Buffett say? Like, buy when there's blood in the streets. Well,
100%.
we see people having problems.
That's a fact. That's a fact. Listen, Will, man, I really appreciate you coming in the lab and not only giving us the background, but also showing us how you've kind of built what you've built. Just shout out to Matheson Capital and shout out to Evan, man. Obviously, and building that empire and then being strategic with how you got there. And again, everybody has their own journey, and yours is a remarkable one. And I think it embodies what being an experimenter in the lab is all about. Taking an opportunity, seeking it out, and then continuing to double down on what works when it does work. So I gotta ask you, man, you seem obviously very young, just like myself here. You're planting seeds. Where do you want to take this thing, man? Like, and again, when I say that, I should preface by saying I used to be thinking like, oh, it's about the amount of doors that you get. And then we got into a very interesting niche. And it was not even about the number of doors. It was about the amount of cash flow and the opportunities and strategic partnerships. So I've had a paradigm shift. So I don't want to feel like I'm taking this question and making it about, hey, how do you want 100x, 10x? I'm more curious as to what's going to fulfill you and what's going to continue to drive you to keep moving forward. What opportunities are you excited about with Matheson Capital?
Yeah, so I have not had a paradigm shift like you. Our goal is growth. We want to scale up. We want to vertically integrate with property management, which I think we're in the process of working on. But our goal is scale. I mean, we're based in Charleston, South Carolina. So there's this, little company, Greystar. Maybe you've heard of it. That, they're in town. They're the biggest property manager in the world. So it's not like we don't have anybody to look at and say, wow, that's something to chase. Not saying we're going to chase Greystar, but our goal is growth. That's what we're focused on doing. I think multifamily and student housing is still a phenomenal asset class. Obviously, I don't think we're going to have a repeat of the last 10 years where everything goes up in value, threefold, fourfold, whatever that number is. But it's still very difficult to build housing. We still have a housing shortage. I think I was listening to a podcast. It mentioned that there are no new build houses for sale for less than $250,000. It's just it's very hard to build. It's not changing seemingly. So I think housing is still a fairly good investment.
No, man. And you said that, are you right now as we speak currently have vertically integrated property management company, or is that something you're looking to build out?
No, we have a partner we do a lot of in-house management with. He comes in, he joins our deals, Fabio Noguera. Hey, Fabio. He's great over at Stantino. So he does great work. Truly, truly an amazing operator.
That's amazing. Listen, man, I have no doubt that you will. I think you're want to talk about someone who's definitely got the momentum in your favor. Definitely double down. Don't slow down. And it's I'm excited to see what you're going to be able to build with you, your brother, your partners. And I appreciate you stepping into the lab and sharing this game with me. I gotta ask you one thing, man. There's a thing that you believe, whether it's a book, resource, mentor, or someone that you look up to, or someone that you get a lot of insight from. Drop it here with experimentation so we can tap into the mindset or the foundation that kind of gives you a little bit of insight when you're doing your daily experiments. Is there something that comes to mind?
I mean, I don't want to pick any one person, My wife means a lot to me. I obviously work with my twin brother. I've been fortunate to meet a lot of really successful people. If I'm just going to if you want me to just pick one book, I'm sure you've had it said on this show, I don't know how many times. I think Atomic Habits is a really useful book, just in terms of it's really important to just repeat the same processes. I mean, if it's a good process, but just repetition, putting in the work over and over and over again. I know it's a cliched answer. I don't want to get too obscure, by saying from a businessman to his son is my favorite book or something. Atomic Habits, I think, is a great
you can
book.
100% be obscure, right? My books that I read some of them are not even on people's radars. I'm a big mindset guy, and I love that you shared that with us, man. I appreciate that.
Yeah. Well, no, thank you for having me. I really appreciate the opportunity to come on and talk about what we do here.
Absolutely,
wish you the
man.
continued success that you've had.
I appreciate that, man. I appreciate that, and definitely want to stay in touch. I'm as good as my resources and my peers. So if there's anything you want to put out there into the universe, just let me know. And I usually get thinking of the who pretty quickly. It's just like it's beyond 6 degrees of separation at this point, man. I got to tell you, it's getting wild out here. So if there's anything that comes up, I know I get your number over here, man. I'll hit you up, but I'll keep you top of mind. I know what you're trying to build, and tight circle. We'll be watching, man.
Yeah, well, I appreciate that. Thank you.
Awesome. I'll let you conquer this every evening. And just like that, Experiment Nation, we are out.
Experiment Nation, your host Ruben Kanya here. Listen, if you're looking for a who in your next steps as a short-term rental host or Airbnb host or operator, that is, definitely make sure that you reach out to me directly by booking a call to see how you can get yourself to the next level. If you've never turned a house and repurposed it into a short-term rental or Airbnb, if you don't know what pricing tools to use, how to set up your listing so that's best optimized, how to set up a PMS software, let alone if you don't know what a PMS software is and why it's important, to, again, having dynamic pricing as a tool to stay ahead of your competition, to always be booked and not only be able to pay your mortgage, but cash flow some, and always make sure that you're giving your guests an experience that will have multiple other guests want to stay at your property, how to automate reviews, how to automate check-in details to messages for the guests, and so that you are no longer working in the business, but you're working on the business, how to build a virtual cleaning team, all of the above. Make sure that you go to experimentrealestate.com/hospitable-hosts, where you can book a call to see if you're a good fit for the coaching program that I am offering only to limited partners. If you're a part of Experiment Nation, if you're new to Experiment Nation, well, it's all about having the right individuals help you guide you through the next steps of where you're trying to go in your experiments. So if you're looking for guidance, if you're seeking out guidance, someone to help you, I am rolling out a new coaching program that is very hands-on. Therefore, there's only limited spots available, where you will work with me directly and I will help you take your short-term rental or your long-term rental into a short-term rental if you've never been a host before, or help you get to the next level. So make sure you go to experimentrealestate.com/hospitable-hosts so that you can take your experiments in the short-term rental space to the next level with a guide and someone who's been there before. Again, I look forward to seeing you on the call. Make sure you book a discovery call. We'll see if we're a good fit for one another. And again, be sure if you're driving, if you're currently not available, to take the URL down. It will be in the bio description. Looking forward to seeing you on the other side, and continue to experiment wisely. Happy hosting.